Well, let's continue our market coverage with the Canadian stock market reaching an all-time high. It's been getting a fresh lift from the banking sector as some of the earnings have been rolling in. Case in point, the numbers today from Royal Bank, which topped expectations. Let's talk a little bit more about some of the driving factors. Rebecca Teltscher is a portfolio manager with Newhaven Asset Management. Rebecca, it's good to see you.
Nice to see you.
And what's been your sort of overall takeaway so far from the banks that are reporting results? Does seem to sort of speak to us, arguably a resilient Canadian economy, but what's your sense?
Yeah, it's interesting. I've been talking about this for a year now. It hasn't come to fruition yet, but I feel like there's a big disconnect between the market and the economy. And we kind of see the economy showing signs of weakness, but the stock market just keeps reaching all-time highs. And so with bank earnings coming out yesterday and today, I feel like it's a bit of a self-fulfilling prophecy. So, all this optimism in the market is obviously leading to higher stock prices. Higher stock prices is going to lead to, more activity on the capital market side, higher returns on the wealth management side. So obviously banks are having higher earnings right now. Also, more optimism in the market generally leads to maybe taking lower provisions as everything is okay. So now you have these banks that are posting these great earnings and they're up, and generally investors view Canadian banks as a barometer for the overall economy. So there you go. Okay. Everything is great.
There's the carousel. Is there a but there?
Can this go on for longer? Absolutely. We're a little bit more cautious. I mean, when I'm reading through the details of the earnings, so, RBC, for example, let's back up. A few months ago,
sure.
All these banks were increasing their provisions. There was a lot more uncertainty in the market. I mean, there was tariffs, but there was also just general weakness in the economy. We have that mortgage cycle of those 5-year mortgage rates that are going to come off, that
True.
are expiring and are going to be refinanced at much higher rates. That hasn't fully happened yet. So you had banks, rightfully so, taking more provisions. At the time, the market looked at that as a positive thing. Banks that are taking higher provisions are viewed as more conservative. So now we've seen a reversal of that. We've seen banks taking less provisions, and that's now viewed as positive because the economy is supposed to be great. Actually, we've seen RBC and BMO release previously taken provisions to help boost their earnings. So is it a little bit too premature to be releasing these provisions back? I mean, we think so. Has the market cycle peaked? I mean, again, I could see a case for both, but at Newhaven, we always like to take a more cautious stance.
Sure.
So, we are seeing signs that, employment is getting weaker. Housing is, anecdotally at least, is not seeming great right now. So could we see a situation where provisions get higher and we see loan losses get higher? We could see that. And if that's the case, then maybe these earnings are a little bit too optimistic, and maybe the market's reaction is a little bit too optimistic right now.
And any change in those provisions always sort of immediately flows to the bottom line. So that's a consideration for these earnings as well. Point taken. I want to connect the dots with something else that you guys focus on, which is, areas like infrastructure, investing in, the power economy, if you will. And there's been a lot of focus on, Canada's opportunity to grow over the long term, big projects, things like that. You could make the argument that that's sort of a longer term possible help for the economy. But between investing in sort of those big thematic opportunities versus investing in, let's say, banks, is it an and or for you? Is there opportunity for sector exposure across the board?
Yeah, so don't get me wrong, we like the banks,
yeah.
Like we own it for clients. It's more of a question of, will we be adding more to it at these levels? I mean, we think it's a little bit, again, premature, a little bit too optimistic right now. That being said, we like, the fact that Canadian banks are an oligopoly. We like their capital positions. We do think that they are positioned more conservatively rather than the U.S. banks. But to your point with regards to infrastructure, infrastructure, I mean, one of our largest weightings have been, the utility and pipes, and right now the focus is on banks because they're reporting, and we were seeing, huge, increases and huge performance. But we've also seen big performance in, let's just say Enbridge and Trap and Fortis, Emera. We've seen huge moves in those stocks as well. But I would say we're more confident in owning those infrastructure stocks because unlike banks that, their earnings could be driven very much by policy, infrastructure stocks, I think, are driven by consistent growth in power demand and a need for infrastructure to continue to be built.
Well, what's interesting about those two sectors, because I was looking at some of the Bloomberg breakdowns just this week, is both financials and utilities sport higher than average dividend yields. But of course, when you're looking at dividend yields, you also want to make sure that there is some, healthy support for those dividends. And both of those sectors are expected to see dividend growth, according to some of the Bloomberg projections, over the next 3 years. How important is it to be seeing companies that are constantly able to commit more capital to investors, outside of whether or not they're growing their bottom line performance?
Absolutely. Again, it's, for us, we are dividend-focused investors. So we want that balance of being able to have a sizable yield, continue growing that yield, and to make sure that dividend is safe. And obviously, capital appreciation is, we look at it as it's important, but it's more of a bonus. If we're going to get close to 5%, yield on dividends, then we really only want the market to give us that extra 1 to 2%. So we're not relying too much on the market. For example, NVIDIA, that's going to be releasing earnings, is pretty much only focusing on capital appreciation, since that dividend yield is almost nothing. Right. So we like to, that dividend is a commitment to the shareholders to continue paying their shareholders quarter after quarter, despite what the stock market is doing.
So I guess a final question related to that. We'll see what happens with NVIDIA. It does feel like the entire economy is tied into the AI boom, because there's so much spending all around just the idea of having this technology at your fingertips, including through infrastructure and power. How closely do you have to watch that sort of main story on the AI boom as it pertains to that?
So we're watching that story with regards to the demand for power. I don't know who the winners and losers of AI are going to be. Just like in 1999, we didn't know who the winners and losers of the tech boom and the internet boom were going to be. I think it's too soon to tell. We also think it's too soon to tell how these companies are going to be able to not just bring AI into their business, but monetize it. I think we've seen a lot of we see the power of AI and what they can do, but how is it going to result into earnings, and are those high multiples justified? So again, those are all uncertain. For us, what is certain is if AI is here to stay, we need a lot more electricity. We need a lot more, not just electricity and power demand, but that infrastructure to transmit that power to the end users, whether that's going to be through data centers or whether that's going to be consumers like me and you that are going to be using more consumption to use AI in our day-to-day lives.
All fair points. Rebecca, thanks very much.
Thank you so much.
Good to get your perspective. Rebecca Teltscher joining us from Newhaven Asset Management.